going to start with strengthening EMU in the aftermath of the Greek crisis. I think there's some other crises too, but the Greek crisis is a significant symbol at least. And we'll start with 10 minutes from each of the panelists, and then I might comment on a couple of things that they say, and we throw it open to general comments and questions. And I'll aim to end a little bit after 6, but not much. So I think we'll just start at this end, or should we go alphabetically? Doesn't matter. Let's start at this end. Let's go one by one.
Okay.
Sal Cooley.
Thank you very much. It's my pleasure to be here. You know, it's a little, after 2 days of all this discussion and commentary by some very well informed and thoughtful people, it's hard to think of what you have to add to the discussion that hasn't already been said many times. But our assignment was to look at the 5 Presidents' report and think about what that report had to say, and to comment on that and comment on the issues that are raised. And the 5 Presidents' report sets out at least 3 goals for the future of the EU and monetary union, and that is to achieve true banking union, to achieve economic union, and to achieve fiscal union. I want to comment on these in turn. Banking union, I think, is the most critical missing element in ensuring the stability of the EU. And I assess the progress towards banking union as being kind of a mixed success. So there are several parts to this. One is a single supervisory mechanism. The other is a single resolution mechanism. The third is that's non-existent, but unified deposit insurance system for Europe. And then another piece of this is the concept of capital adequacy for European banks. Now, the single supervisory mechanism, I think, represents substantial progress. It's still hampered by the fact that European directives, EU directives, to be implemented, have to be implemented by applying national rules. But there is a strong institution. The single supervisory mechanism and banking union in general should eliminate cross-border, or at least reduce cross-border externalities within European Union. But, and the single supervisory mechanism is probably the strongest element of the pieces that make up banking union. Why is it the strongest? It's the strongest because responsibility has been placed in the hands of a strong institution, the ECB. The ECB, when it was created without leaving a lot of individual discretion to sovereigns. And that's why it's been successful. That's why it's a strong institution. That's why, even with respecting national sovereignty, it's likely to be successful as a banking supervisor. Notwithstanding the legal complications that people have discussed here, and those are many. The single resolution mechanism, it's carefully laid out. There's a very good analysis of the single resolution, and there are many open issues. There's a very good analysis of the single resolution mechanism that's done by the World Bank, and it lays out the decision-making process for resolving an insolvent bank or an institution that's in trouble. And if you read that process and the number of decisions that have to be taken by the number of different committees, it will give you a headache. It will take you couple days to read and understand all the steps. And when a bank fails, that's not the time horizon that resolution operates under, at least not in the US. And so that is a victim of this kind of, what seems to me, this sort of confused relationship between the notion of a community and the sovereigns. And it cedes way too much decision-making and way too much discretion to national authorities in the resolution process. The third leg of banking union, I think, is and a leg that would have made a big difference in the Greek crisis and would make a big difference in future crises, is to have a common deposit insurance scheme. That requires, in turn, more fiscal centrality than currently exists. And as far as I can tell, people here know better than I do, but as far as I can tell, every time that gets raised, it gets tabled, that there's been absolutely no progress towards that. Lastly, I want to, as far as banks are concerned, I want to talk a little bit about the notion of bank capital adequacy that seems to have come to the fore in Europe. It's sort of part of a discussion within the G20 in general. But the question is, but it's been embraced, I think, to a greater degree in Europe, the notion of bail-in and the concept of total loss absorbing capital for banks. So the concept of total loss absorbing capital imagines that banks will have an extra layer of capital, particularly GSIFIs, particularly globally systemic financial institutions, an extra layer of capital that will allow bank holding companies to continue to operate, that can be bailed in, that will allow bank holding companies to continue to maintain the operational capacity of their individual units. And this has been endorsed, enthusiastically embraced throughout the European banking community, as far as I can tell, and the central banks, among the central banks. And it ignores a very important problem. So what is this total loss absorbing capital layer about? Well, it is whoever holds that debt, that convertible debt, is essentially writing insurance against the systemic failure of the financial system. It's a great concept if you're thinking of a world in which banks fail one at a time. It's the wrong concept when you think, well, it's not the wrong concept, but there are deeper questions that have to be answered if you think about a systemic event. Precisely because of the fact that this is insurance against the catastrophic failure of the financial system. So the question you want to ask is, who's going to hold this? Who's big enough to hold this for the financial system? Do you want other systemic institutions to be holding this? Clearly not, because that will just exacerbate the domino effect of financial crises. Are insurance companies big enough to hold it? Do you want pension funds to hold it? This is a problem. This is an issue that I think that needs to be thought about a little more deeply if you're going to think about this capital concept as insuring the financial system against systemic events. As I said, issue by issue, bank by bank failure, it's fine. It makes a lot of sense and it should work. Economic union. Well, I think that the issue of economic union has been discussed by a number of people. I was going to put up some slides, but Ramon already showed you one of the slides in his introductory remarks, a chart of mine which shows the rate of growth of GDP for the European countries. And what you see is that up to 2010, there was some arguable case for conversions taking place, and from 2010 on, what you see is divergence. And you see the same thing if you look at the same plot of the employment population ratio, if you look at consumption, if you look at investment. After 2010, there is divergence, and it's not getting better. It's getting worse. It's getting more extreme. So I greatly enjoyed the talk of Chris, in which he talked about thinking about the future of the union in terms of divergence, or as a series of, as a set of institutions that are appropriate for diverging economies. But I have to say, I have trouble getting my mind. What is the point of this if not to ensure some harmonization? And some harmonization of economic fortunes would seem to be at the heart of what the goal of this enterprise is. If we're not sort of harmonizing economic institutions and opportunities, then what is it that we're doing? Okay, so a third thing, I've been given the 1 minute sign, so I'll just be brief, and that's fiscal union. What Europe needs and obviously would benefit from, and I think some of the research attempts to address this question that were surfaced in this conference were really, really interesting and exciting. I think there's kind of a false dichotomy that's been drawn between discretion and rules. I mean, the union and the treaty have lots of rules, but rules can be flaunted. And so I think the right way to think about this is to think about institutional designs that constrain behavior. And I'll give you an example, and this is an example from the States that harks to what David talked about, and that is, in the US, the states have independent fiscal policies, but they don't go bankrupt. They can't declare bankruptcy. There's no provision for that. So what happens? Well, why does this work? It works because in the most fiscally important, not all states, but most fiscally important states, most states have constitutional amendments that give general obligation bondholders priority. So they get paid before the state workers get paid, before the prison guards get paid, and no politician wants to face the case in which the state police and the state government workers don't get paid. California is a good example. What happened? Is this just an empty promise? It's not. California in the 1990s, David, did you get paid with script with promissory notes?
No, because we work for the University of California. They're an independent state.
Some California workers got paid with IOUs because California exhausted its budget. So I think when we think about, so this is kind of a general point about how you should think about institutions and rules and how you should think about institutional design. What you want are designs, institutional designs that effectively constrain behavior. Arguably, if some of the sovereign states of Europe had a provision for debt priority for general obligation bondholders, they would think a little more seriously about pensions and about social transfers and so on. I'll stop.
That's a good place to stop. You're out of credit.
Issue some IOUs.
Yeah.
And we move on to René Smith.
Okay, thank you very much. Thank you for having me here. I'm glad to be here as a lawyer in this predominantly economic conference. I have 4 generic points to make, and first a disclosure and disclaimer. I partially work for the ECB as a member of an independent review panel for supervisory decisions, and nothing that I say can be imputed to the ECB. Having said that, 4 issues. First, legal themes that I think are important to focus on even for economists. First of all, it has been said already by Joachim Almunia. When I listened to him this morning giving his keynote speech, I thought, my God, he's taking away everything that I wanted to say. But let me briefly repeat what I had on my plate already this morning to say. Economic governance is far too Byzantine, too complex, and too contentious in approach, union versus state. And we have sufficient contention and divisiveness in Europe already. So I think we should focus more on joint economic policy making, and there is a challenge to explore the limits of Article 1221 of the treaty. I don't have a slide, I cannot bring it up to you here, but 1221 of the treaty is the only meager competence given to the Union to have its own economic policy. Second of the legal themes that I wanted to mention is something that has been done before, integration of the intergovernmental public international law instruments into union law proper, already foreseen in the various legal instruments. Something that I think contributions from a legal and economic perspective could be useful for. A third point, a final point, also mentioned by Almunia this morning, finally, single representation of the euro area in the international fora, membership of the IMF. And there we need a novel interpretation of old terms such as country in the IMF's Articles of Agreement. I refer to Article 138 of the treaty, which was already there in Maastricht, which actually mandates this. Last of the four legal issues, in spite of what I said about integration of the public law, intergovernmental legal instruments into union law proper, let us not shy away from using what I would call extra-treaty-torial instruments initially, if necessary. Second point, 4 areas of urgent action. Joint partial financing of national unemployment insurance. There has been an interesting proposal by a German group, the Glenicke group, on that. Second, it's been discussed, already mentioned, joint issue of euro bonds, which may start by joint issuance of treasury bills. I must confess I've been a member of a group that proposed that, so another disclosure. An issue that you just mentioned, state bankruptcy. A euro area sovereign debt restructuring mechanism is really due. We need that. And that is not a stance that is in conflict with advancing stronger federal fiscal powers, as I would favor. Fourth point here, preparing joint euro area decision making, and in the direction into which that has to go, whether we need to have COSEC, the Conference of Parliamentary Committees on European Union, focus more on this area, whether we should have those in European Parliament doing that. Of course, the Commission, Euro area Treasury calls consistently made for that by Jean-Claude Trichet. Third set of things to bring forward here, rethinking conditionality and the conventional approach. I think that Europe would be in a much better state nowadays if we had given more emphasis to structural reform before we give it to austerity the way we did. And I would like to call upon the researchers, and I'd like to give that as input also as member of the advisory committee, to challenge conventional wisdom or policy consensus. There is a book that has recently been written and now issued by an FT journalist, Martin Sandbo, Europe's Orphan. Very interesting contribution, staunchly pro-single currency, and debunking all kinds of popular myths about what went wrong in Europe thanks to the euro. He's debunking that, but attacking the policy response and undermining the idea of the conventional approach, although sometimes breezing over legal issues, especially the boundaries of the ECB mandate, as I heard people do this afternoon also, when they said that the ECB was actually behind the illiquidity of Greek banks. Second point under this heading, what can actually be seen on the ground by citizens and by business, which is the issue of the practical use, the societal benefit of research. Let me give just 2 examples, which are not research related, but policy related. The actual impact of the Juncker Fund, the European Fund for Strategic Investments. Of course, it's early days, but I'd like to see practical things happen. I know that I have 5 minutes only. Thank you very much. Another issue, The internal market, how well does it really function for ordinary citizens and business? But I would not think that we should be bound within the political reality in our research or our thinking. I think you just said crises at the very beginning, Richard. Lateral thinking, combining crises, is something that I see not often enough. And finally, to lose even what I would call sloppy use of terms in the public sphere and in research. All kinds of terms that are used without defining them. Economic union, political union, democracy, sometimes also terms used with a political agenda behind them. The unelected Italian prime minister, the FT wrote for many years, as if prime ministers on the continent are elected ones. Other examples, countries or member states, which Chris referred to today. My final point, fourth set of thoughts, what I would call the cultural aspect of European integration. We go way down from economics now, but let us, perhaps this is something for ADEMU philosophy or consciousness of implied assumptions. On a practical matter, I think a second common language in Europe, which of course is English, sorry to say for the French and the others, is something that we really need for effective labor markets, single media space, and for a more European consciousness. But it goes further than that, the cultural aspect. It is also about transparency and information. Transparency about what actually happens. We don't see our media, and perhaps there is a function here for our researchers, or our politicians telling the people what the ESM is and how it functions, and they let others and the populists go away with telling people, and people believe that we take money out of our own budget and then spend it on Greece, which is complete misrepresentation. I could say more on that, but I'm fearing the 1 minute sign, so I'm moving on to my final point, which is wider, which is perhaps an issue that all researchers should be aware of, their own frames of minds and the limits of our own views. I've been very much confronted with that these 2 days. Being a lawyer and sociologist by training, not an economist, you'll find that there are all kinds of other perspectives. But let me give you a linguistic example. Are we aware that the word dat, when translated into German, means Schuld, which is both guilt and debt? Are we aware that austerity in German means Sparmaßnahmen, which is savings measures, which is something that every household and every individual wants to do and is positively framed? So I think true listening is required, expanding consciousness, something ADEMU and perhaps all of us need to do. Thank you.
Thank you very much, and thank you for keeping within time. And we move on to the next one.
Thank you very much for the invitation. Inspiring 2 days, and for me very pleasant to return to macroeconomic issues. Let me reflect with 3 comments. One, not surprisingly, on the monetary policy, as I spent 12 years in the central bank. One on the fiscal policy framework, and the final point would be on the convergence issues. Regarding the monetary policy, I was quite lucky because I spent 12 years in the central bank. It was the golden age of inflation targeting, or generally speaking, the type of policies where inflation is one of either the single or the key nominal anchor for the central bank. So I mean, I include also the ECB in this respect. And all the time we were doing something with interest rates, so that we were performing standard monetary policy. And I ended up in 2010. At that time, we were very close to zero interest rate area. And since 2010, what happened? In fact, the interest rate channel has been closed, so that my former colleagues started to unconventional monetary policies at the end of 2013. So that in fact for 5 years, and it's not only the case of the Czech National Bank, it's just an example. So we are in an unknown territory. It's a question of the framework for the future. For me, I'm still a believer in inflation targeting framework, or that framework which works with inflation as a nominal anchor. But at the same time, I admit that I'm not sure whether we can return to this to that framework we had in the previous decade. I don't see anything else at this moment, so that it's the challenge for central bank as well as for the research. Quite often people speak, and even central bankers, about, and it was mentioned already today, leaning about the policy leaning against the wind. Fine. For me, it might be associated with the financial stability mandate. Nevertheless, from my perspective, it's quite dangerous to relate it to the monetary policy. From my perspective, the enormous advantage or progress regarding the monetary policy in the last 25 years was predictability and transparency. And if you imagine the situation then when the forecast of inflation would deviate from the inflation target, so the central bank should respond, but the central bank would not respond and would argue, okay, we see some tendencies in other markets and asset prices and real estate, so that we would not respond. So then, in my opinion, it might be appropriate. Nevertheless, it's inappropriate from the point of view of long-term transparency and predictability. So certainly, financial stability mandate is, from my perspective, it's correct that it's within the central bank. I believe that the central bank is the right institution, especially in case when the central bank is also responsible for the banking supervision. But then it's very important to distinguish these two mandates and to cope with the potential conflict between the financial stability mandate and the price stability mandate. And it may be also about processes. Let me give you an example. We took into account the financial stability issues, and a couple of years ago, before 2010, 2008, 2009, we said, okay, we should take into account some, these trends in the economy from the point of view of the financial stability as well, so that. Typically, we had on Thursday morning the presentation by the staff on the monetary policy and discussing recommendations, and we decided in the afternoon. And we said, okay, financial stability issues should not be included directly into the decision making, into the presentation. Nevertheless, we had that presentation on Wednesday. And it depended purely on members of the board whether it would be reflected somehow in how they would perceive the risk. Today, if I should make the decision again, I would make that separation in a more decisive way. So in other words, I would separate more that financial stability presentation and the monetary policy decision. So it might be also about those technical details, how to distinguish between these mandates. So there might be something new. In fact, I don't see anything which could replace that inflation targeting frameworks we had in the previous decade. But it's true that for 5 years we are in a different territory. So this is. For me, one question for the future. For the future. Secondly, the fiscal policy framework. There has been a lot said in these 2 days about that. Well, there's a lot of issues. Obviously, some institutional improvements are appropriate. On the other hand, it's not only about institutions. Let me remind the case of Hungary, because in Hungary it was constitutionally designed, in my opinion, a couple of years ago, very strong institution, but then the Orbán's government changed that, so that I'm just saying that the constitutional is not everything, and it depends very much on how the society perceives that issue and on the demand from the side of the society. This is another point I would like to make, is the difference between a relatively technical monetary policy and the fiscal policy, because the fiscal policy is much more an inherent part of politics, And that's why it would be much more difficult to make a relatively technical discipline in that area. So that I would welcome the type of policies or institutional settings that would increase the pressure on politicians and to increase the transparency and predictability. So some kind of fiscal stress testing. We ran a project with some colleagues for OECD a couple of years ago, and we ran a small model for Germany, Austria, and the Czech Republic. And by the way, it was relatively close to how the monetary policy was designed. So that we set a target for the deficit, and in fact not for the deficit but for the debt to GDP. And then we provided forecasts of public finance, and obviously if it deviates, the government should somehow respond. By the way, there was one interesting outcome, that we have some rules, and it's also related to the debate on the rules, that we have that 60% cap on debt to GDP. Intuitively, there might be differences across the EU, so that there might be different target levels for individual countries. Obviously, for Germany, for the UK, the sustainable level of the debt to GDP would be a bit different than in Latvia or the Czech Republic or Hungary. So I was always arguing that, for instance, the Czech Republic should not speak at all about 60% level, and that it should be stricter. So that my guess is that it should be about between 40 and 45%. And it was also the outcome of our exercise, because it turned out that sustainable level for Germany would be above 80%, and Germany would not have any problem to maintain the debt at levels around 80%. And for the Czech Republic, the model indicated that 45 would be quite dangerous. So 60% might be an interesting cap. Nevertheless, there should be national discretion, and that national countries should be stricter, in my opinion. But obviously, speaking about the European rules, this can be a bit difficult to persuade national politicians about that. I see two options regarding the fiscal discipline. Mostly we hear that we need a fiscal union. I'm not persuaded about that, because somehow we forget that there is another disciplinary tool, and this is financial markets. So somehow and quite often we hear the argument that the monetary union cannot sustain without the fiscal union, but we can leave it up to the financial markets. The punishment can come from the side of financial markets. Financial markets made a mistake, and it was a wrong assessment before the crisis. So as soon as a country became a member of the Eurozone, somehow it started to be perceived differently. Let me give you an example. Our good neighbor and loved friend, Slovakia, they announced to become member of the Eurozone, and immediately their yields started to fall down. So that always they were a bit above the Czech yields, and it's within a couple of months it was below. But fundamentally, nothing happened from the point of view of the economy, from the point of view of the fiscal sustainability. So I think that this is the second option, which has not been discussed too often. And the final point is on convergence, and I think that the final objective, so we can discuss frameworks, which is fine, but the final objective is the sustainable economic growth, and within the EU, convergence from the point of view of economic performance. And I see there one challenge for countries which are not at the core of the EU, including the Czech Republic, but also Spain, Portugal. and it's about the what I would call the model of growth. We were converging in the previous decade quite strongly and in a sustainable way. And we reached the level 75, let's say maybe 80% of the EU on average. And this is very similar in other countries, including what I mentioned, Spain or Portugal, but other emerging market economies, not only in Europe. And this growth is typically based on the what I would call the buffer in productivity, and based on the foreign capital, the last sentence, the foreign capital inflow. And when you exploit that productivity buffer, so then the convergence stop. So that these preconditions like monetary and fiscal policy frameworks and other policies, this is a certain precondition, but still for me the biggest challenge regarding the convergence across the EU is the drivers of the economic growth in individual countries. Thank you.
Thank you, Zdeněk. Now, Frank, I can't really get at you from here, you see what I mean? So I'm going to have to trust you to keep you 10 minutes.
Well, you can shout too.
Well, all right, okay. But the credibility of the bank is online here.
No, I don't think so. Let me start by saying that whatever I say is my own view and not necessarily that of the ECB or my boss, President Draghi. And let me also thank Ramon for the invitation. So I will violate Charlie's sort of self-imposed rule that the central banker should not talk about fiscal policy and focus mostly on fiscal union. Although, of course, I've been involved in some of the drafting of the five presidents' report. So in the discussion, I'm happy also to discuss some of the other unions. And of course, one of the big points, I think, of the report is to highlight the interactions between these various unions. And as a matter of sort of research question, I think that is a very important research question. It's a very difficult one because, of course, immediately your models and your analysis becomes more complicated. But I think it's key to get it right. I mean, if you think about why do we need some elements of fiscal union in a monetary union, and I think Charlie already mentioned that, I can think of three reasons. I mean, there may be more. The first one is that we want to ensure sustainable public finance. Now, the question then is, well, why is that bias more important in a monetary union than if you're in sort of a national state? There's a number of externalities that people have talked about. One of them being that some of the implications of higher debt, for example, in terms of inflation, are not internalized. The other reason is that, of course, because you lose your exchange rate instrument or your independent monetary policy, probably you want to have lower buffers than otherwise. And so there is a bit of a sort of a discrepancy between, on the one hand, the need to have larger buffers, and the other hand, the fact that maybe you don't take into account all the externalities of your higher debt on the other members in the monetary union. The second one is the issue of risk sharing. So risk sharing becomes more important in response to shocks if you don't have independent monetary policy. And of course there the question is what should be the share of sort of private sector risk sharing versus fiscal risk sharing. One of the things that we've learned is that neither of them work very well during the crisis, but the two are of course complementary. And the third one is what Charlie called the aggregate fiscal stance. So there is an issue of coordination more generally if, in response to the business cycle. Now, if we do a diagnosis of how has this happened, I'm afraid we can't really draw sort of a positive result. Obviously, we have relatively high government debt to GDP ratios, although on average not that much higher than, let's say, in the US or the UK. Market discipline, I mean, has not worked in the sense that it was very loose in the boom period and then too tight, I would argue, in the recession period. And so we have to examine why didn't it work, what made the no bailout condition incredible. Fiscal policies have been, as a result, pro-cyclical, definitely in a number of countries. But one could argue even in the aggregate because of the asymmetry that we talked about. Although there, depending on who you listen to, it's not always easy to establish that fact. And actually, I would be interested in actually having somebody who shows that on the aggregate, we have been more pro-cyclical fiscally in the euro area than, for example, in the UK or the US. And then third, I already mentioned that. Fourth, the degree of risk sharing, both private sector and public sector, has been very small. I mean, it was already small relative to the US in both cases, but it was even less, I would say, in the sovereign debt crisis. So the question is, how can we improve these elements of fiscal unions so as to better achieve better results? And when doing that, I think one also has to take into account some of the realities and the constraints. One reality is that national fiscal and economic policies will remain dominant for the foreseeable future. So dreaming about a United States of Europe, obviously, that's a nice dream to have, but it will not happen in the next decades. So that means you have to think about how to if you think there are these biases, how to discipline these national policies. Second is that politically, obviously, there is no, currently in the current debate, there is no appetite, public appetite for a transfer union. So the degree of permanent transfers that can be supported by our money are limited. And I was very happy to see that this was one feature of the work that Ramon was presenting. Third, some of the adjustment mechanisms, alternative adjustment mechanisms like migration, are likely to remain less important than, for example, in the US, although, of course, we've seen quite a bit of migration, more migration than we've seen before in the context of the crisis from certain countries to Germany, for example. Now, one of the things that I think is also useful to start off is the corner solutions basically don't work. And there are basically three corner solutions. One corner solution is you have national fiscal policies and you let markets work, financial markets work. Why doesn't this work? Because there will always be shocks. If you think everything is driven by moral hazard issues, then that probably is a solution. But that's not the case. There is a stabilization role of government debt and of fiscal policy too. And so that basically get destroyed if you only have, basically you get pro-cyclical policies. And that will undermine the benefits of being part of the monetary union. The second corner solution is to have national fiscal policies, but let them control from the center. That doesn't work either, because basically politically that's just not feasible. You want execution and control to be as much as possible at the same level. So politically, that's a no-go. The third solution is basically a US type of solution where you have a fiscal policy becomes to a much larger extent central. Also, that is not a solution. Now, the Maastricht blueprint, so to say, was to realize that the first two corner solutions are not feasible, so we're going to combine them. Right? We have the SGP, the Stability and Growth Pact, which basically puts constraints on national fiscal policies, but we also have the no bailout principle, and that's supposed to strengthen the market mechanism. And the hope was the combination of the two would be sufficient. Of course, what that did is it focused mostly on this first objective. How can we lean against that bias? It did not take into account at all the fact that there's also stabilization role and that there is a trade-off there. And so one way of how I look at where we need to go is how can we strengthen the third corner solution. I mean, not by making a corner solution. How can we strengthen the central capacity, the fiscal capacity, in order to make the three poles stronger, in order to make market mechanism working better, in order to make central control of national fiscal policies more credible politically, and in order to provide sort of this stabilization mechanism. And that's kind of in a simple way or intuitive way, I'm not sure it's a logically clear way, but anyway, how I would start thinking about the mechanism design. So the key question is, given that the dominant part of fiscal policy will remain within the realm of national competency, how much market discipline, how much policy coordination and surveillance, and how big a euro area fiscal capacity do we need to achieve the objectives of sustainability and stabilization? And how can we structure these three elements such that they actually reinforce each other rather than work against each other? So before I just briefly go through each of the three elements and ask basically some questions, which are basically research questions, I just want to say one thing about interaction with financial union, because I think that interaction is key, and to some extent also with economic union, but let me not talk about that. I mean, there are at least three elements where we have to think, when you think about fiscal union, you also have to think about financial union, and the reverse. The first one is that they're, as I already mentioned, they're complementary. So the more financial risk sharing you have, probably the less fiscal risk sharing you need. And that's because fiscal risk sharing is not politically very sort of attractive and maybe difficult to achieve. This is also one of the reasons why there's so much emphasis was put on financial union and banking union in the first response to the crisis. So it requires that, now of course to get more financial risk sharing, we need to delink the banking from the sovereign risks. That I think is very important, and has been one theme within the measures that were taken. But we also have to think about promoting equity-based rather than debt-based financial integration, which was one of the problems, particularly if it's short-term debt integration through the money market. And that's of course also where capital markets union comes in. A second interaction with financial union is that an effective financial union requires a strong common fiscal backup. And so that's a fiscal component of financial union. And that's where one area where also the Five Presidents report has been sort of quite clear, that we need that fiscal backstop. And I think for me the natural role would be with the ESM to do that, to provide that. Now, this doesn't have to be a very, so often it's said, oh, this is mutualization of lots of risks. I mean, clearly mutualization of risk across the euro area, but not necessarily for taxpayers, because this comes at the end of now a long process. No, if we have, and I think Tom talked about, first of all, hopefully we have better supervision. The distance between Frankfurt and Madrid, or between Frankfurt and Valencia, is definitely longer than between the Valencia and the CACA. Now, okay, it remains to be seen, but hopefully the supervision is better. Secondly, we have now the resolution regime. So to the extent that that is credible, and I agree there is issues about if it's a systemic crisis, but to the extent that it's credible, there should be 8% bail-inable liabilities where the creditors of the bank would be first bailed in. And that this will start as of 2016. Thirdly, if that's not enough, then of course, basically a fiscal backup would have to come in, and that's where part of the negotiations are ongoing, where there's a lot of friction, but which is key in the end to make it the whole infrastructure, architecture credible. But even then, the idea is to actually recoup those from the financial sector. So the notion, I mean, it's really a backstop. It doesn't necessarily need to imply big fiscal taxpayer money risk sharing. And the third element of interaction that I would see with the financial union is basically the provision of a safe asset. If we do not provide a sort of a robust safe asset within our monetary union in an environment where the regulators basically are asking banks to have liquidity coverage ratios, to hold more safe assets, this is going to create a problem, and again it will it's just not a consistent thing. How much more time?
let's see, I make it 1 minute, actually.
Okay, so 1 minute for my third. So just questions on, first of all, enhanced market discipline. How can we enhance market discipline? There, I think, really going all the way in terms of delinking the banking from the sovereign is. Why is bail-in not credible for the government? To a big extent because there's contagion vis-à-vis the banking sector, and there is also contagion vis-à-vis other governments. I think we are slowly dealing with the contagion vis-à-vis the banking sector. Obviously, in the Greek case, we've seen that we're not there yet, but that's where we have to go. What more needs to be done, and again, the Five Presidents report is very clear about that. We need to have a European deposit insurance system. The Commission will come up with a proposal in November. Now, we'll see how that will be received, but there's some momentum and also some resistance towards that. Secondly, I think we also have to think about sovereign concentration of banks, of exposure of banks to sovereigns. This is something that has to come at the end. We should not make the same mistake as we made in the Deauville, that we first sort of put the sovereign in a difficult position and then think about the banks. No, the sequence has to be the reverse. We first make sure the banking sector is sound and safe and protected. That means completing banking union. And then actually we can start credibly thinking about having a sovereign debt restructuring mechanism. The third element is basically fiscal capacity. And there the question, which I didn't hear, we had a little bit of a discussion about investment fund versus employment and insurance versus common tax instrument. I think we have to answer that question. And I'm not sure I've heard sort of a convincing answer. It has to be a common tax system. If we think about the stabilization mechanism that is mentioned in the Five Presidents report, what is it? Should it be investment, goods, financed by common tax? Should we have, should the Commission or whatever, this finance minister be able to issue that? Should there be an unemployment insurance system? I think these questions we really have to answer if one believes that a minimum fiscal capacity is necessary. Thank you.
Thank you very much. Okay, let me make a couple of comments and then open up to the floor. One, on strengthening EMU since the crisis, etc. I think we do first have to be clear on what the weaknesses were. Some of us, I'm not sure how many, don't share the narrative that all these structural weaknesses were fundamental. If you look leading up to the crisis, it didn't look like that at all, and there was convergence, and so on and so on. And I think the Sandwell book is a useful corrective to that. Now, on the other hand, you do have there seems to be some, at least a claimed consensus in the Vox EU book that's just come out that the crisis was really basically a sudden stop in the standard literature sense, the Calvo sense. I don't share that consensus, and I think broadly then we do need to be clear, at least clear on our differences about what brought EMU into crisis and whether it was really fundamentally misconceived and misconstructed and so on and so on, or did it just face a shock the like of which nobody could reasonably have expected. The second point is a legal issue. I was surprised a little to hear Renee say we need an SDRM, and I guess that's because my reading of the legal issues, and I've done a lot of work on sovereign debt, is that an SDRM for the euro area alone just isn't feasible. I mean, where are contracts going to be written? Are they going to be written under English law, or New York law, or German law, or French law? If they're written only under French and German law, then there will be a real difficulty for people who want to borrow in euros if they can only write, take out securities under French or German law. I don't see that happening. So that's a legal issue. Another legal issue, very important and I think not fully appreciated, is state aids. There was a huge amount of state aids. There were whatever. A huge volume. There was a huge volume of state aids in the period up to the beginning of 2013 to bail out the banks. Germany was allowed to do it, Spain was allowed to do it, and now, since the 1st of January 2013, it ain't legal anymore. And the Italians are finding it virtually impossible to set up something like a bad bank or an asset management company, a bad asset management company, to deal with the non-performing loans because of the big gap between what's being provided for on the books of the banks and what they would have to sell them to a bad bank for if there were no state aids provided. It sort of seems unfair to the Italians. It seems unfair, but the law seems clear right now. The third point is on the ECB, and it really arises from what Janet was talking about on macro-pru, a combination of monetary policy and financial stability policy. The ECB's powers are absolutely enormous, and I think we sometimes just don't fully recognize this, and it is, I think, a big, of course, it's a political issue, but it's an issue for the articulation of responsibilities within the ECB itself. To what extent can you really have Chinese walls and so forth? But if you've got monetary policy, micro-pru, and the 127 banks that number will grow and grow and grow. Everything will end up being under the SSM. Macro-pru, micro-pru, payment system, goodness knows what else Mario's got hidden in that big new building. It does seem to me that we are in a very different regime from that the founders intended. Now, I certainly was one who believed that you couldn't separate financial stability from monetary policy in the way that the Maastricht interpretation was. But I think we have to try to cope with this new distribution of power, if you like. Is resolution feasible, Tom? Absolutely not. You're absolutely right. I mean, you need the World Bank to tell us that the complexity of the process is clearly just not. You can't deal with it over the weekend, which is what you need to be able to do. And it's not clear, what would happen in that context. Somebody really better shout and say, hey, come on, let's get serious about this. On risk sharing, let's not overdo it in our assessment of the United States. I gather this was talked about yesterday. I saw a very interesting little bit of data the other day about the extent of unemployment insurance. Most unemployment insurance in the United States is provided by the individual states. It was only in the 6 months after the crisis began and unemployment shot up and you had the federal unemployment system. That was then lengthened somewhat, but since that extension expired, it's basically state. Okay? And the degree of labor migration is also underestimated, but that's another subject. And finally, risk sharing through the financial system. I think that is really extremely important, risk sharing through banking union. But I think that banking union and the capital markets union. But I think one has to recognize that the regulators don't like this. Be clear. The regulators, national regulators, do not like giving up their authority. And you saw, for example, in Germany, UniCredit being unable to transfer liquid funds from its German subsidiary to its Italian subsidiary. That's just one manifestation. It's not the only. There are many cases of that kind. And the national regulators don't like the idea, of course, of anything but zero risk weighting of sovereign bonds, and so on. Now, I think part of the answer to that latter, that final problem, and I'll stop here, is something that Philip knows I disagree on, but we'll see. There's some resistance. Is instead of prescribing positive risk weighting, say large exposure limits. And I think large exposure limits are clearly the way to go, and I think that came out of some of the discussion that was made on the panel. In breaking the sovereign to bank link. So those are my observations, and now open to questions. I see Phil Lane first, John.
So I want to
Questions and comments, indeed.
comment slash question to Frank about the sequencing and setup. So one type of cross-border equity risk sharing is equity in banks. So if you cross-border banks, you know, and this is one interpretation of why the Baltics recovered maybe more quickly is their banking system was foreign owned. So I mean, it's kind of at the intersection of banking union and promoting cross-border equity and so on. Is there any? Do you perceive, are there any barriers that need to be overcome to promote more extensive cross-border equity in banking, which could take different forms? It could be consolidation, it could be multi-country banking with common. Well, so I think there's an issue there which cuts across both banking union and risk sharing. And then the other sequencing issue is, I don't disagree that at some point in the future, maybe 10 or 15, I don't know when, 10 or 15 years from now, maybe everything will have been set up that we can start to think about partial mutualization of debt. But your first comment was, there's not much appetite for fiscal union. So, I'm not sure if mutualization of debt, even partial, when appetite for that will emerge. So, short of that, are there other ways to have some kind of safe asset of Europe without having mutualization?
Other questions? Ramon?
Well, first of all, thanks for all interventions. This one issue which is related to things that have been said by Tom, by Senek, do I say it right? And also by Frank. I mean, we got the clock back and we think about the creation of the ECB and in a sense, this sort of thing was relatively easy from the theoretical point of view. We already understood bank independence. We quite a lot of things understood about monetary policy, and in particular, you created a figure with an instrument, huge instrument. Now we're talking something that actually we don't have a good theory for that. And you made a point saying, well, the problem is that this is much closer to politics or policy, as you were saying before. And that's an issue, because that comes with the fact that there's this confusion. People at this moment, okay? So talking, for example, of the Treasury, some versions, they put it basically in the euro blue. And I will fully agree with what Almonia was saying this morning, is that cannot work, okay? So there is an element of it has to be more independent from this intergovernmental kit, but then this morning, we are a little confused on exactly what it is. Because it's not just a problem of time inconsistency, as it is in monetary policy. There are elements of time inconsistency, but it's not just this. And then it comes to exactly which kind of instrument. Of course, what we also know, when we had a lot of discussion, is that to do this supervision and all the recommendations, this doesn't go much. So like this peer review stuff, I mean, it's good to have it. It's good to have the other stuff with better information, but we don't go too far. I mean, and we can create these IFIs. They're very independent, but then you don't have any power. That doesn't go very far either. So how we have to something that we don't want it to be so independent that no one pays attention, and we need some instrument. But there is this element of confusion still there, and I think that's part of our whole problem too. But maybe you have better views now.
Take one more, I think, and then go to the panel. Yes, in the back.
Yes, I have a question for Renee, which very closely resembles what Richard commented on the difficulties regarding the legality of SDRM. And my question rather pertains to the political feasibility of it, because I remember correctly, N. Kruger, failed dramatically at the IMF in trying to get a SDRM going on a global level, and I don't really see the willingness among European leaders or in the euro area to actually concern SDR, although it would certainly be very desirable. So apart from the legal aspects, what would your take be on the political aspects? And my other question is going to Frank. On the, you mentioned the desirability of the safe asset, which I certainly share, and having marginal debt on the national level, but given how difficult it was to even how that Eurobonds didn't even fly at all at the height of the crisis 2 or 3 years ago, how realistic do you really see, or what do you think are actually the chances of having such a pan-euro area safe asset in the foreseeable future, given that you said that the second corner solution you mentioned isn't going to happen anytime soon? Thank you.
Just narrow that down even to the maybe the most politically feasible possible safe asset would be the Christian Helvig Thomas Filippo short-term safe asset. That I'd be interested to hear what Frank thinks about that. I mean, if you have really short maturity, the amount of risk that taxpayers in Germany are taking isn't very high. Any other comments before we come back to the panel? Okay, let's start from the end. Start with Frank. If that's okay.
Yeah. The question on the cross.
You don't have to answer all those questions.
No, I won't. The question of cross-border banks. I mean, clearly there are still some. I mean, the SSM should improve the possibility of reduce the fact that we have the SSM, which is now working on harmonizing some of the differences in rules and regulations that still exist across countries. That should improve or reduce some of the constraints that exist for sort of cross multinational banks and mergers and acquisitions to take place. And I think if you think about, compare Puerto Rico with Greece and why that, I mean, Krugman said it is transfers. I think that's part of it, but probably the more important thing is that, of course, the banks in Puerto Rico, or Citibank, who were actually in New York. I mean, they're not. So I think that is key. And of course, before the crisis, I mean, definitely there were national champions, and to some extent they still exist. But at least the instruments to keep those national champions will be less.
But why did Hungary need liquidity assistance in the crisis?
Who?
Hungary, with the banking system basically completely foreign control. Hungary, I think, if I remember correctly, the ECB provided.
It was an IMF program.
Right. Plus, of course, I mean, in the case of Hungary, there is the so-called Vienna Initiative, no?
Yes.
Which basically mitigated the problems, liquidity problems.
The ECB didn't approve. But why should you have needed liquidity assistance given that the banking system was foreign control? I forgot that George Shurai had some authority in this matter.
Because the non-core banks withdrew their claims from Hungary. So the banks like which were not represented organically in the Hungarian market provided liquidity substantially prior to the crisis. Immediately when the crisis hit Europe, withdrew their flows. And the ECB didn't provide anything. It's been a swap facility against AAA government securities,
Right.
which is nothing. You can sell it on the market whenever you want.
Fair enough. No, I knew the limitations. Sorry, I interrupted.
Okay, just the other question on safe asset. I mean, what are the chances? I mean, I'm not sure I know what the chances are, but for sure there are big constraints and concerns. And I think one part of the research and the analysis should be to try to see how can we address those concerns. And there's various ways. I mean, the SB's proposal that Philip has been involved in is one way. Now, it's still not clear why that proposal is not provided by the market, and so there must be some because in the end somebody could structure it the way you propose and provide it. And of course that's where maybe a little nudge is needed, and of course there's discussions on the regulatory side whether that could be helped. I think another way of addressing the concerns is to make it short term, and of course that's the Christian Helvig proposal. I mean, a third way is what, for example, Clemens Fust, who was quoted earlier today, is called accountability bonds. So actually you link the issues of mutualized debt to certain actions on the front of fiscal consolidation or on the front of structural reforms. So
How is the market going to price that?
Yeah,
Excuse me.
big signal extraction problem.
You bet.
in any case, that's so. I mean, I'm not sure which one of those or if any of those will eventually materialize. But the point of what I try to say is that there are these different sort of constraints, and we just have to think about how can we come up with solutions that do not ignore the fact that there are these constraints, because they're real.
Good.
Well, when the ECB was set up, there was no precedent. It's true, but on the other hand, it's the central bank, and it covers the region. And euro, it's the fixed exchange rate in a number of countries, so that it's the regime we knew, and there was not so much new issues regarding how the monetary policy should be performed. Fiscal policy is very much different from this respect, because it's much more, I try to emphasize that, it's much more difficult to reach that independence which we see in the monetary policy. A reallocation of taxpayers' money, it's the core of politics, so that I can hardly imagine that we would ever reach the independence we have in that area of the monetary policy. And that's also why I'm relatively skeptical regarding any significant progress regarding the fiscal union, so that we can set up some rules, but always there will be the problem with the enforcement. We can set up new institutions, but once again it would face that standard reallocation processes at the national level. So so that we can make those institutions stronger or set up new ones, but I don't think that progress would be significant. So there might be some part regarding the fiscal union, like deposit guarantee scheme, that there would be pan-European system or something like that. But in general, on a massive scale, I don't think that framework would be substantial. So that's why I would not give up completely that discipline coming from financial markets, and the fact that there was a failure, it doesn't mean that that doesn't work and the system is completely wrong. Democracy failed several times in the 20th century, and still we don't have a better system at this moment. So that's why I would not say everything was wrong. So that there was a mistake by a number of agents in the economy, by the authorities, by financial markets, but still it doesn't mean that we should get rid of everything.
Thank you. Great.
Let me first, thank you. Let me first say something about this. Not going into that discussion completely, but I do think that financial markets have been relied upon far too much in the Maastricht scheme of things. Let me say something about that restructuring. You have two types, contractual or statutory, and I know that the statutory SDRM proposal the IMF has failed completely, but that doesn't mean that within the European context we wouldn't be able to go beyond the CACs, the statutory kind of, the contractual kind of instrument that we're already following. What we have in the two-pack is at least one regulation which comes close to it in the sense of putting a member state really very much under tutelage of the European Commission. One step further would be something that Frank alluded to in a mutualization, making sure that there is some kind of okaying from an EU Treasury in certain debt issuance, and it's only one step further from that to say if this debt issuance leads to a situation in which there cannot be a repayment, then there is an orderly arrangement for restructuring, which I don't see to be barred whatsoever by some kind of preference for state law in the issuance. But I'd love to discuss that later on. Let me just make one final comment on the big building of Mario Draghi. You're apparently not aware of the fact that there are more buildings. That
No, the whole building is housing all those supervisors.
No, not yet, but that's going to that. I wanted you to know that. Thank you.
I'll be very brief, since I'm the only one standing between you and a drink. So the one thing I want to say is to underscore what Frank said, and that is the reason why market discipline failed in Europe is because of the unholy relationship between banks and sovereigns. And that drove policy decisions, and in part, that's a result of bad policies on the part of the ECB, which gave sovereign debt zero risk weights. And so, I'm sorry, that was global.
Basel.
Basel, yeah. Okay. So, bad policy decisions. Wrong. And that's why market discipline failed. And then until that problem is addressed, then market discipline is going to fail again. Even recent policies are driven to a large extent with one eye on the issue that you're trying to address, Greece, and the other eye on the health of the banks, rather than thinking directly about the banks being healthy. So, amen.
Amen indeed. Thank you all very much, and thanks in particular to Ramon for his leadership in this project. Obviously, colleagues, a number of colleagues. Exactly. But I know where the leadership is, and I'm very, very pleased with the way this thing is going on. Thank you all again.